Yeah, I think, look, the management of the company will probably be a bit shocked to say we've had this as an income stock. We could have had it on our growth model at the
Yeah,
time
okay.
as well, but we didn't. But it just happened to be when we became re-interested in it. We used to hold it many years ago. There was a bit of a hiccup a few years ago. It's recovered magnificently from that. We didn't get involved again until, I don't know, a year or so ago, a bit longer. And at that point, I think the dividend yield was 4.5% because it's always
Okay.
paid a dividend. There just wasn't an opportunity to get it in our growth model.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Good to see you, Lee, as always, for another very busy week of news, results, stories from the stock market.
Yeah, absolutely. As always, we try and condense as much as we can into 30 or 40-minute episode. And we usually do start off with international news and general news, but we thought we'd lead with a company that's just recently had a 40% jump in share price. It's a company on AIM, Filtronic. It's 300% up for the year. And we thought this was really worth just touching on first because it's just announced some good news in a trading update. It's got some really great contracts.
Yeah, it's fascinating. The company's Filtronic. It's Sedgefield-based, northeast of England, County Durham, and it manufactures products for the aerospace, defense, telecom infrastructure, and specifically low Earth orbit space markets. And this is a thing that's really captured everybody's imagination because it announced, great update this week, good results. But the really big news was of a very big purchase order. And the purchase orders come in from SpaceX, Elon Musk's SpaceX, to help support its Starlink operations. And the orders for initial purchase order for about 16 million, just under 16 million. And the businesses said, look, we're trading ahead of expectations. We're actually trading ahead of expectations now for the following year. So boom, up go the shares. And yes, look, this has been a great story this year. The shares are up 300% in the current year. So it highlights the money to be made in smaller quoted companies. If you do your work and sit there a bit patiently, you can get a great return.
I'm just curious, were the signs there earlier to indicate that this may happen? Because, as you say, it's gone up 300% this year.
Yeah, if you look back, if people that look back, you can see there are lots of contract awards. This business has been announcing lots of new contracts. The signs were already there that they were trading ahead. And there was an indication or rumor had it that around about at the end of December, they announced a large contract, a $6 million contract award for similar type of product that they've now awarded that they've named from SpaceX, which the implication was that it might have been from SpaceX, but it wasn't named at the time. So no name was out there in the public domain. They just said, we've got this contract from a US customer, which is pretty attractive. But yeah, so if people have followed this, and you'd have seen some good contract awards, the backlog's building up. I think the important thing is with this business, which is demonstrated from what it's saying the results are going to be, it's confident of manufacturing its orders. We've had problems with other early stage engineering company called Surface Transforms, which makes ceramic carbon brake discs. It's had huge problems trying to manufacture. Filtronic, I think it's got a handle on actually getting the stuff out of the door, which is key.
Well, they've been around since 1977, so this isn't new to them, is it? They should have quite a bit of experience in manufacturing these
That's
components.
really interesting. Yeah, they have been around a long time. And yeah, they probably had time to get it right.
Did you know that share price was once above £22 during the
Wow.
dot-com?
Wow. So this really was a dot-com bubble stock. And it's
Yeah,
taken a long time. It's taken a long time to come back then.
yeah. It took a couple of years to get to £22 and about a year down to £2.50. And then since then, it's steadily declined. But hopefully this is the start of something new for it.
Yeah, now with the help of SpaceX and I see it's got a contract with another agency, a space agency. Now its time has come. It's brilliant.
Yeah. SpaceX have been quite clever in the way they've wrote the contract as well, haven't they, in this?
Well, I think this is really canny. So they've awarded them this contract. However, SpaceX have got a warrants. That's the rights to acquire shares in the business at a certain price. And the price is, I think it's around about 33p. current price of Filtronic is about 47, 48. So SpaceX have got the rights, assuming the contracts are formally executed and the contract awards come through from SpaceX. SpaceX have the right to acquire, I think, up to $10 million of shares in the company, only 33 pence a share, big discount. So it's a win all round. Filtronic get their contracts. Hopefully SpaceX get good products and they get to carry some of the upside in the value if they're holding in Filtronic as well. So a sweet deal, I think, for SpaceX.
Yeah, very sweet deal. They get the products that they're buying and the upside of the share price as well, which may cover some of the cost of what they're purchasing it for. So fair
Yeah,
play.
you got it. You got it. Really nifty.
Yeah, so we wanted to mention that first of all because we thought that was quite a good bit of news around a UK company and in particular on AIM. So, should we now circle back to the international news and starting off with Spotify, which many of you here now listening are probably maybe listening through the platform Spotify.
Yeah, I thought it was worth briefly mentioning. Spotify is well-known business. We're all using it. Probably nobody has much of a clue of what how big a company is. It's Swedish, but listed on the US stock market. It's worth about $56 billion, which is huge. But ironically, it hasn't actually made any profits, real profits in the sense of accounting profits. It generates a lot of cash, but hasn't made any real profits. But its results have been great. It's generating lots of growth and revenue. If it was a UK company, it would be within one of the top 20 companies on the UK stock market. It's that big, this business. It's got 615 million monthly active users. I found that absolutely staggering. But with aspirations, they're projected to hit 900 million by 2028. These are huge numbers, aren't they?
Yeah, they really are. I love Spotify. I use it. I think it's brilliant. Most of my family have accounts with Spotify, paid accounts as well. So they've brought out a new feature, the artificial intelligence DJ, which is a real nifty feature. It looks at your listening history and it picks out genres that are associated with your listening history and then starts to drop in new songs or new genres that you may not have come across. It's brilliant. It just widens your awareness of different music that you probably may not have come across. It's a real cool bit of feature.
That sounds brilliant. And it's obvious, but isn't it? So you, as a user, would have had first insight to that well before some notional investor interest in it. But I think, has it been out a while, that feature? Or
Yes, it has actually. Sorry, I say that. I say I've only just come across it. I think it's been around about 12 months, but I've only just discovered it myself. But since I've discovered it, that's all I play now. I just play the DJ in the app.
That's so good. I think it's a sign of how it's moved as well. It's put more into its own technology. It was overpaying, sort of endorsing celebrities to do podcasts, which
Yeah.
they weren't driving any uptick in the user numbers. Whereas this kind of feature clearly is very popular and people are willing to pay for it.
What do you think about the fact that it hasn't actually made a profit yet, though? It's worth 56 billion, but
It's a quirk of its. I looked at the numbers a bit. Like, it's not a company I know massively about in terms of its financials, but I looked at the numbers, and a lot of it's a quirk of share-based compensation. So companies that have high share-based compensation, they're remunerating their staff in shares rather than cash, have to disclose these in their income statement, which often drags them into losses. But that doesn't mean, as it implies, that they're paying out cash. So their cash generation is pretty strong and they're in a net cash position. But yeah, it's a funny old quirk. And you often see it as well with companies that are highly acquisitive with lots of goodwill. They have to write that off and that drags the reported results into a loss, whereas actually they're very cash generative.
yeah, I think most tech companies opt with that type of strategy, don't they, of the share option scheme for their employees.
They do, yeah, they do. And that's why you see a lot of tech companies undertake share buybacks. Why they're doing that is to keep the number of shares in issue basically flat, because otherwise, if they're issuing more and more shares, the share count will go up and up. So they try and buy back shares as much as they can.
Yeah, I wonder if Spotify one day will look back and it might become one of the Magnificent Seven or Magnificent Eight.
We're amazing. We're
It-
certainly amazing.
yeah.
Daniel Ek, the founder and CEO still, he'd certainly be thrilled. I know there was a great program about it, about the origins of Spotify. I think it was on Netflix, but I think his frustration was that Sweden never built a technology business. Well, they have now. They have a mountain of a technology business here in
Yeah.
Spotify.
Should we move on to a company that is making profit, but the share price dropped?
Meta is absolutely booming. Meta Platforms, former Facebook, it owns WhatsApp, Instagram, as well as Facebook, and the revenue up 27%. It's a massive company, of $36 billion just shy of high end of guidance. So everything's going great. The shares have been doing really well. Why on earth did they fall 15% on the day? It's actually as much as 20% on the day. They lost nearly $200 billion in the day of their results. So people go, why? When a business is doing so well, why? The key issue was, dear old Mark Zuckerberg, he's decided to commit to huge expenditure in AI. Previously, he did this for the metaverse. There was loads of commitment to the metaverse. Everybody got a bit upset. Well, the shareholders did. He reined back on that, cut the costs back. Shareholders loved it. Share price went up. Fortunately, we've gone round full circle again now. The AI spending is going to be accelerated, which hasn't gone down well at all.
I suppose the shareholder base are concerned that we're going down the same road as the metaverse, aren't they?
Exactly. It is a sort of FOMO, fear of missing out scenario here, you
Yeah.
feel, with a lot of these businesses. Thankfully, Meta has an awful lot of money, so it's got the cash at its disposal to do this. But Wall Street, the stock market is concerned.
Yeah, two other of the massive tech companies reported really good numbers, didn't they? And equally, these are also constitutes of the Ultimate Stocks portfolio, which is on Investors Champion website. You can get full visibility of that and all the write-ups and articles that Chris and the team do on the Ultimate Stock portfolio.
Yeah, you're right. They've been part of our portfolio. I think we dwell on the Alphabet because Alphabet, as we speak, the shares are probably likely, the value is probably likely to go past 2 trillion. So it's going to join the 2 trillion plus brigade of Apple, Microsoft, Nvidia, now Alphabet. Unbelievable numbers. This is a huge business, but it has just announced operating income, net income, operating up 32% to 25.4 billion,
Wow.
25.5 billion in the quarter. This is a massive
That's,
company
yeah,
that is delivering this kind of growth. It's just mind-blowing. On revenue that was up 15% to 80.5 billion. So, its search business is going great guns. YouTube's going great guns. Its cloud business is doing nicely, and it's benefiting from AI. Its cloud business is already benefiting from AI. It's the cash it's generating. Just staggering. $28 billion of operating cash inflow in one quarter. Just
that's
one
incredible,
quarter.
isn't it?
And it sits on just under $100 billion of net cash. So it's decided finally, and this is the thing that's really the stock market's fully in favor of. It's decided finally, and it hasn't done this before, to announce a dividend. Google,
Yes.
Alphabet has never paid a dividend, so it's bought back lots of shares. So in addition to upping its spend on AI as well, it's committing to a dividend payment, just 20 cents a share. So the implication is that's only a quarter. If you annualize it, the yield is under a 0.5%, but it's
It's
still a starting point.
with them committing to a dividend, does that mean they're finally running out of ideas of what to do with all that cash?
Some people have exactly made that point. It's a really good point, and they are upping their spending in AI, and
Yeah.
they're starting to make a bit of money on the AI side. That's benefiting their cloud business, which is good news. Other thing, investors should be aware with Alphabet. What you'd get with Alphabet are pretty clean numbers. They don't go in for adjusting items. So this is a company that's spending vast amounts of money in areas that may well never deliver anything. They may not get anything from their Waymo cars and all their other what's called bets on the future. But it doesn't write off much. It doesn't adjust much. Sorry, it clears everything. It expenses everything, and it doesn't adjust them out afterwards. So you get very clear numbers. And even after all that, the forward rating, the PE multiple that a lot of investors look at is only 24 times forecast earnings. Now, I know many smaller growth aim companies, if they reported accurately and didn't put all through these jazzy adjustments, they'd be trading on far richer multiples than 24 times forecast earnings. So
Right.
a good business to look at. And we thankfully our associated business Fundamental has held the shares for a long time as well, as they have held Microsoft as well, which is also doing very well.
Yeah, and again, they're in the Ultimate Stocks portfolio as well on Investors Champion website, aren't they? Mm,
Absolutely, yeah. You can see
mm.
all the constituents, subscribers to Investors Champion can see all the holdings of our ultimate stocks portfolio.
So that's two that are performing exceptionally well. Long may that continue. But there is a company within the portfolio that's struggling a little, shall we say, Nestle. Their sales fell more than expected, didn't they?
Yeah, they did. They're not doing so well. Clearly, the opposite end of the scale to the technology giants. And Nestle, very well known for its confectionery, food, beverages, side drinks. However, one area that seems to be doing okay and is at 20+% of this business is its sort of fancier pet food business. Purina One, Fancy Feast, and Friskies seems to be doing quite well. And pets care pet food is a big contributor to Nestle's growth and numbers. So hopefully we'll see some better performance coming out of that.
Yeah, they've managed to ride the growth in pet ownership, haven't they, over the last 2 or 3 years, maybe 5 years, since COVID, really. I think COVID, it really accelerated, didn't it? But,
It did, yeah, it did.
many young couples opting for a dog instead of children.
Yeah, I know, I know. They've had a position in pet care and puts them in a pretty good place going forward. Nestle is a pretty good company, run company, and a sort of a steady portfolio holding, in our opinion.
Yeah. What is it? 21%, I think, the pet care for its overall profits, isn't it? Which is
Yeah,
a
which is
significant
substantial.
amount.
Yeah.
Yeah, it is. As we tend to mention in most of these episodes, we've got another French super luxury brand that's
I think this is almost as incredible as the Alphabet and Microsoft's growth stories. I mean, this Hermes is a very old brand that deals with high-end luxury goods, and other high-end luxury good companies like Louis Vuitton, Moet Hennessy, another one of ultimate stocks, have not been growing so fast. Kering, the owner of Gucci, has also put in a warning that its growth has slowed. Hermes, 17% growth in the first 3 months of 2024. Everybody was saying that the high-end, luxury high-end is suffering, especially because of the slowdown in China as well. But this business is going great guns. Well known for its Birkin bag and Kelly bag. It's just unbelievable. It's, as we've spoken about before, it knows how to nurture the brand, support the brand, limit supply as well. It doesn't overproduce. It stands at a very high quality, way at the top there, and it just keeps on delivering.
yeah, and we're going to get onto a company which operates at the absolute opposite end of the luxury brand, which is Primark. We'll touch on the parent company that owns the brand Primark, which has been doing very well. And it just goes to show, doesn't it, that if you're at the high end, yeah, you're probably going to do all right. And if you're at the low end, you're doing all right. But anyone in the middle, Super Dry, Dr. Martens, them type of brands have been struggling, haven't they?
Yeah, they have. And yeah, so the owner of Primark is a business called Associated British Foods. Many people won't know that it owns Primark. It was founded in Ireland, but it's owned it for a while. And Primark's doing well. Associated British Foods as a whole is doing well. It owns lots of food businesses as well. Allied bakeries, sugar businesses, and ingredients businesses, they're doing fine. But its Primark one has always been the sort of standout performer, and its revenue is growing 7% odd, which is good news. So bottom end doing well. Top end doing well as well.
Yeah, just in the middle, struggling. So,
In the middle, struggling. You need to know your place almost, don't you? If you
yeah.
get caught between two stools and you're more exposed to the consumer downturn, which clearly maybe Super Dry is.
Unfortunately, as well, we've got some bad news for the London Stock Exchange, and BHP has proposed to buy out Anglo American and has suggested that they may take it off the London Stock Exchange. So that'd be another potentially big blow for the London stock market, wouldn't it?
Well, yeah, if BHP takes over Anglo, that'll be another loss, another business gone. And BHP has already moved its its primary listing from London to Sydney. So Sydney's already got the accolade on that. But yeah, if we lose Anglo American, you mentioned last week, I think, when Shell is talking about
Yeah.
making soundings of moving to New York because nobody likes it or it thinks it's undervalued, it could be significant. But I think this is going to run and run. Shareholders have already said, look, several have come out and said this is an opportunistic deal. You've got to pay up a lot more than this if you want us to sell out. So yeah, there could be a lot of talk on this one that we're going to have to follow now over the next few months because the 31 billion is clearly not enough for holders.
And hasn't Ocado mentioned or rumours are that they may relist in
Yeah,
America as well?
yeah, they've been saying that their sort of valuation isn't, well, they're not correct. Their value isn't correctly assessed on London. They get a better hearing on perhaps the Nasdaq or New York. I'm not convinced. I think Arcado's valuation looked pretty punchy on London at one point, and it's simply under delivered to an extent. But yeah, we'll see. We already lost Arm as well. Arm Holdings. They decided to choose New York rather than London to list. But yeah, there's not much joy in terms of the London Stock Exchange. You don't seem to be bothered. But then again, you can buy your shares anyway. It's very easy to buy shares now on any exchange. Doesn't cost you much either to buy shares on the US stock market or the UK. And you don't have to pay stamp duty as well if you acquire shares on US listed companies. So that's been also an argument that people are bringing forward to attract more companies to list in London to lift the stamp duty sort of imposition for UK listed stocks.
Yeah, that's interesting, isn't it? That the stamp duty could potentially be a barrier because
Yeah, I think it's a trifle. It's 0.5%. AIM shares haven't had stamp duty now for, I don't know, 11 years. And has it made a huge difference? I know we're talking different volumes of transactions
Yeah.
between main market and AIM. But as we said before, every little helps.
Yeah. Do you think Brexit's had an impact on these companies wanting to leave the
I
UK
do, I
stock
do, I
exchange
do.
now?
I do. It's a case of follow the money. Where's the money? The money's moving into Europe, one consolidated market. Financial services, some of the European stock exchanges have got relatively stronger. I think we talk a lot about some of the companies on the French market are doing well. Frankfurt's got some big businesses, more variety as well. You've got luxury goods, France, and you've got obviously engineering and the engineering sector, the automotive sector in Germany. UK's been very much commodities and banks. But yeah, follow the money. Where's the money? Most of it's in New York. People beat a path to New York. And I don't think, as you say, Brexit's probably helped. The money's moved elsewhere.
Or is it an excuse for these CEOs to blame the London Stock Exchange for their poor stewardship of the company?
That's another good argument. That's another good argument.
Yeah, anyway, we'll leave it there on that topic, shall we?
Yeah,
So,
yeah.
we do have some good news, though. We've actually got a British company here that is looking at buying an American company. So it's nice to hear that JD Sports is looking to buy retailer Hibbert.
Yeah, I mean, I'd never heard of Hibbett, but it's one
No.
of these unknown US businesses that go under the radar that has 1,169 stores.
Wow.
We probably hear about it in the UK if they had that many stores, but
Yeah.
it's just over $1 billion deal. JD Sports has aspirations to grow in the US, lift its revenue there to, I don't know, over 30% of its revenue come from the US, and where it is now about 30, up to 40, apparently, from this deal. Hopefully it works out. UK companies haven't got a great track record of acquiring in the US. But yeah, I hope it works out for JD. And it's nice to see it going the other way at last, at least.
As you mentioned there is always risks involved. Best of luck to JD and I hope it works out.
Yeah, I hope it works out.
Could be a shining example, hopefully. So we move on to the AIM news now. Company Supreme doing well, but a debatable whether.
Yeah, Supreme. It refers to itself, and I'll read this. This is interesting. This is how it refers to itself, what it puts down as a leading manufacturer, supplier, and brand owner of fast-moving consumer goods. It fails to expand there that its fastest-moving consumer good that has been driving all its growth of vaping products, and clearly they're under a bit of a cloud, no pun intended.
No pun intended.
We've got bans around it, and so it's no accident, really, that Supreme carries a very modest valuation. Its shares trade on a very modest price-earnings multiple, P multiple, of only 6 times. But really, that's not surprising, given its product set. Many investors will be uncomfortable, not only just about the vaping, but about the market and uncertainty surrounding the bans and regulatory restrictions that might be imposed on their core growth product. But yeah, look, it's in that space. You can take it or leave it, really.
Yeah, and that comes down to an investor's individual choice, doesn't it? Are they comfortable investing in a company like Supreme or they choose not
absolutely,
to?
Absolutely.
Jet2 still looking very good and looking cheap as well.
Yeah, it put a nice announcement out this week. It narrowed its guidance range for profit broadly in the middle, still where it was. Going to make profit pre-tax of around between 515 million and 520 million pounds. It's a lot of money for the current year. Its bookings are looking good. It's got new Airbuses coming on board, which has been canny as well. It hasn't bought Boeing. It's got new fuel-efficient Airbus buses coming on the fleet. It's got a new operation from John Lennon Liverpool, so it's taking bookings from that. It's got another one in Bournemouth as well, due to be flying from Bournemouth Airport in 2025. And look, the valuation looks really modest, but after this announcement, the shares fell back. I thought looked a bit harsh because it's not as if they're expensive. This is another business that's trading at quite a modest value. People are fearful about the impact on consumer spending. Is it going to be hit? It's demonstrated people still want to travel, don't they? If anything, they don't want to necessarily spend on other things, but the one thing they want to do is travel. And Jet2 has a good proposition.
Yeah, the shopping in Primark and going on holiday.
Nail on the head. And the beauty of this business, we all pay in advance. It's got loads of cash, more customers pay in advance, more cash on its books. And cash in the bank nowadays gives you what? You can earn 4 or 5% of it on interest. So it's earning quite a nice lot of chunk of finance income as well, on top of everything else. So, yeah, I think Jet2 looks in good shape.
Is it a member of the Ultimate Stocks portfolio, Jet2?
It's not, but we do hold it in our associated. Fundamental Asset Management has a big position in it across our AIM IHT portfolios. We've held the shares for a while now. They got really cheap. They were a crying bargain during the pandemic. They sold off massively. and they were just too good to miss at that point. They were so cheap, and
Is
we
that when
obviously
you
it was
stepped in with
we were
fundamental?
holding before, but it just we started
You
adding a
added.
lot and have
Yeah.
continued to make it one of our core positions because I just think they look good value, and it's still got a big founder controlling shareholder stake in it. Mr. Meeson, who started the business, has stepped back from it. He's no longer executive, but he stepped back from that. But he's still got a very big stake. We like that.
Yeah.
His founder's still hanging around.
It's AIM's largest company, isn't it, at the moment?
Yeah, it is. Yeah.
Is there a risk that they may move on to the main market? Do you think is there any sort of murmurings like that?
I don't know. I haven't
You hope
heard
not.
anything. I hope not. I certainly hope not, because we've had so many takeovers and
Yeah.
one kind of another, or moves to the main market to cover. But yeah, Mr. Meeson probably is maybe attracted by the inheritance tax planning advantages.
Himself.
Yeah,
Yeah.
perhaps. Yeah, I
Yeah.
hope so.
Fingers crossed.
But yeah, it's a nice business and a good service proposition. It's great reviews as well. Customers generally like what it's doing, which is key. Going back to your point about Spotify, just common sense. Look
Yeah.
at what the world's telling about these companies, if they're doing good things or bad things.
Should we move on to Warpaint then? Fabulous results and anticipated upgrade.
Yeah, Warpaint, interesting name, isn't it?
It
Warpaint
certainly
London.
is, yes. For a makeup company, Warpaint, I didn't think that you would associate those two.
I know, it hits the nail on the head as well. Doing great, doing really, really well. Sales up 40%, revenues up to £90 million. So it's still very small. It's been growing very fast in the EU, not so fast in the UK, but still growing, which is something. And also the US, put a lot of emphasis on the US, where it's grew 37%, so it's revenue to £7.3 million. That's for the year. So it's still small, the US, which suggests either huge opportunity or perhaps has it just made some easy early wins? It's the uncertain bit. This is a massively competitive sector. It's at the very much the low end of it, a bit like I think Primark's we were talking about
Yeah,
earlier.
yeah.
So it's low end. It's not competing with the L'Oreals, I don't think, with its core product set. Again, it's founder run. Two founders are still in there. They own loads of shares, and it's doing very well in Superdrug stores, Boots. In the US, it's rolling out into CVS, the big pharmacy group. So it plays to benefit. And Walmart have put in a big order. So conceivably, we could see those revenues from the US pop up a lot higher next year. We hold it in our one of the fundamental income portfolios because it was a very high dividend yield, and the stock's risen to such an extent now that the dividend yield isn't as high. But yeah, I just do wonder if it can keep this going and how competitors will react to its growing sort of distribution. It will be interesting to see.
What signs would you look out for to demonstrate that sort of, can they keep this going? What would be the red flags that would say to you that actually what I'm concerned about is actually starting to materialize?
They've got to keep the top line going now, the growth going, because the valuation suddenly moved up several levels. It's trading at now 20 to something times forecast earnings. It's benefited from lots of upgrades. It's all about the top line growth. You can see it already. The cash flow hasn't been quite as rosy because they've got their stock levels are a lot higher. So higher inventory levels. If they can't move that inventory, that could be a sign of problems. But really, it's about keeping up that top line growth going. If that starts stalling, could be the signs of problems. Put it this way, it'll impact the valuation. The valuation won't be currently reflective then of a slower growth business as is currently implied.
And of course, it's in the income portfolio, so you've bought it primarily for its dividends. But equally, share price growth is important.
Yeah, I think the management of the company will probably be a bit shocked to say we've had this as an income stock. We could have had it on our growth model at the time as well, but we didn't. But it just happened to be when we became re-interested in it. We used to hold it many years ago. There was a bit of a hiccup a few years ago. It's recovered magnificently from that. We didn't get involved again until, I don't know, a year or so ago, a bit longer. And at that point, I think the dividend yield was 4.5% because it's always paid a dividend. There just wasn't an opportunity to get it in our growth model. So dividend looks great. Dividend growth as well. Always, when you're looking at dividends, it's one thing buying the yield as it is. You've got to be assuming you're getting dividend growth as well. And this company is growing its dividend, a bit like we hope Alphabet would as well.
Yeah, Warpaint operates at the lower end of the market, which, as we've said earlier, lower end seems to be doing well, higher end seems to be doing well. And this company that here on the air market, Sanderson Design, they're operating at the ultra high end, aren't they? And doing very well.
Yeah, in the world of furnishing, luxury interior furnishings, wallpapers, fabrics, I think Sanderson append. And the thing I like about it, this business has been, I think, 1800s or so. Some of its brands date from brands that are called Morris & Co., Zoffany, Harlequin, Scion, Clark & Clark. These are really old brands with lots and lots of designs. They've got a huge portfolio, legacy portfolio of designs. And what they're doing now more is making more of that intellectual property by licensing out their designs to others. They've got licenses with Habitat, with Next, with John Lewis, into other products that they're not producing. So whereas they're manufacturers of fabrics and wallpapers, they're saying, look, you can go ahead and arrange for product production and wholesaling of these products. You can license our designs. And they made 10 million odd revenue from those. And that's 100% profit margin. Clearly, there's little gross margin, that is 100% gross margin. There's no cost associated with that. All right, there's marketing support as well in the operating costs, but this is a high margin activity, licensing, and it'd be great if they could do more of that without diminishing the value of the brand.
Yeah, sounds like the Bioventics of the luxury wallpaper world.
Yeah, it sounds, yeah, it is. But nice business. I'm frustrated it's still in manufacturing. It will argue it needs to be. It has to be. Somebody needs to manufacture its products. But is it necessary? And that bit of the business consumes quite a lot of capital still, having to have the right machinery, digital printing machines. And I would like it to focus on its brand. It must be a massive opportunity. The US exposure is still relatively small. Most of its sales have been in the UK. Marvelously rich market like the United States. Surely they could do really well. They have started to do quite well out there already.
Just coincidentally, you actually had a call with them earlier today, didn't you, before recording? Are
Yeah.
you able to mention anything from the call, or?
They're steadfast in their view on manufacturing. It's the place they've got to be. It's tough in the UK market. UK consumer, it's really tough. They feel that they're going to be distributed through fewer outlets. It could cut in half, but that's not necessarily their revenue's going to cut in half in the UK, but they're just going to be fewer distributors or retailers of their products. So they just have to go about things a slightly different way. But the growth opportunity, I think, is overseas, and particularly in the United States. I hope they make the most of it. It hasn't been an easy journey for them lately. The CEO, I don't know, she's been in a few years now, but I think she's had to tidy things up, refocus, and clearly the licensing bit is a place that she's put a lot of emphasis in. It's starting to come good.
Did they give any indication that they were looking to the US as a potential market?
Yeah, as I say, they're already in there. They're already trading well, and they've got I think 36 people out there, but it's such a vast market.
Yeah,
that you have to be quite canny how you go about it, and they're doing all the shows, trying to woo the interior designers, the usual method. But bit by bit, I think they could do well out there.
Yeah, fantastic. Best of luck, Sanderson. Chris, should we leave it there? That was fantastic.
Yeah, another good episode. Lots to talk about brands as usual. You can't get enough of them. Need supporting, but I think brands are very valuable. A good brand has huge value.
It does. And the thing about brands, though, is you don't know you've got a brand until many years down the line, do you? That's the thing with brands, isn't it?
Which is indicative of Sanderson, isn't it? They probably just cottoned on to the fact, well, hey, we can make a lot of all our work of the last 150 years in designs. We've got some value in these brands. Let's try and use them.
The penny dropped, didn't it? Oh, brands. We've got a few strong brands here, we could make some money out of this.
Yeah.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.